So, but the point being, there's a case where it had nothing to do or little to do with inflation, everything to do with geopolitics. And that's why I call gold the everything hedge. And gold's had a great run recently. We all know that. We can look at the tape. It's hit a series of all-time highs. It ticked up to 2,800 per ounce. It's off that a little bit, but that's normal. Nothing goes in a straight line, so you have ups and downs. But gold is, in the vicinity of its all-time highs. So exactly, people say, gold, went from 1,800 to 2,200 and 2,700 and 2,800. And I said, no, what you're witnessing, that is true from a data perspective, but what you're witnessing is the collapse of the U.S. dollar. Now, people ask me all the time, partly because of my book, Currency Wars, and for other reasons, how's the dollar doing? And I say, well, it's getting a lot weaker. They go, wait, what are you talking about? The euro's down to 106 and the yen's pushing, approaching 159, and the yuan is blowing through 722, and the Bloomberg index is 105 heading to 106. Looks like the dollar is as strong as ever. And I said, well, it depends what you're comparing it to. One of my favorite jazz songs, it was a great live version performed at the Montreux Jazz Festival in 1969, but the song is called Compared to What? And when people say, how's the dollar doing? I say, compared to what? Now, that's a little bit my law school training. You answer a question with a question. But the point is, if you're comparing it to the euro, yes, the dollar is very strong. The same thing with sterling and Canadian dollars and a lot of other currencies. But if you use gold by weight as your measuring stick, then the dollar actually is crashing. So the question is, what is your metric? And I prefer gold for a couple of reasons. It's not that I'm a gold bug. Yeah, I own gold and I recommend it, but I'm pretty hard-nosed about valuation and how much you should have and all that. But when you look at DXY, which is the leading U.S. dollar index, and there are others, Bloomberg and so forth, you're comparing currencies to currencies, dollars to euros, euros to yen, and so forth. But they're all in the same boat. I say the vessel sank. They're all in the same lifeboat. They may survive, but they may all sink together. But they're not going their separate ways. There's not going to be a world where the dollar has collapsed by some measure, and everyone says, "Oh, get me the euro," or get me the Aussie dollar or whatever. They're all going. If there's that kind of stress, they're all going to fall together or be sustained together. So those differences, they're important for currency traders. They're important if you're in the import-export business. Or if you just want to speculate, there are reasons why you would pay attention to it. But as a measure of trust or reliance or faith in the dollar or dollar strength, you're comparing like to like, and you're not really getting an objective measure. To me, gold is that objective measure. It's not a currency. It's a form of money. It's a store of wealth. Serves those roles very well, but it's not something it's not like 1910 where I could get on the steamship in London with a purse of British sovereigns and get off the boat in Shanghai and spend them like they were money. They were money. That was absolutely true in that day. The sovereign was a quarter ounce, 8 grams, basically. So you can't do that today, but as a store of wealth and a form of money, as a monetary asset, that's what it is. But it's not a central bank currency, and it's not a liability. If you study the history of money, and I know you have, most money, various money at various times, is basically the government giving their debt to a bank and the bank issuing bank notes, which is just bank debt. I mean, I tell people, Americans, but I think it's true around the world, take a 20, in our case, a $20 bill out of your wallet or, 20-pound note or whatever, and read it. I was taught that in law school. Read the contract. There's a contract between the government and the citizens, and it says Federal Reserve note. Well, where I went to law school, a note is debt, and indeed it is. Go to the Federal Reserve website and look at the balance sheet, and you'll see all the currencies on the liability side of the balance sheet. So most money is basically governments giving central banks their debt, and then central banks giving them something you can spend. Gold is not issued by a central bank. It's not a liability. It's not a note. It's an element, atomic number 79. So to me, it satisfies the requirements of an objective, if you will, an objective measure of value that's not more of the same. So again, just to summarize, when when I see gold going from 2,000 to, it'll make its way to 3,000, you can call it a 50% increase, but you can also call it a 50% crash of the US dollar. In 1969, the Dow Jones Industrial Average, that today the S&P is kind of used by portfolio managers, but in those days it was the Dow. In 1969, the Dow Jones hit 1,000. It then crashed, up and down, volatile rallies and declines. But we had a severe recession and stock market crash in 1974. I graduated from college in 1973. I guess I wasn't ready to have a job. I went to grad school, but all my friends went to Wall Street, and then they were, euphoric and great Christmas parties and all that. I saw them all a year later, and they were all unemployed. I was too. I was a student, but it was an interesting time. But the Dow did not hit 1,000 again until 1982. So you had a 13-year period. It went down, up and down, but it took 13 years to recover the old high. So you say, okay, 13 years, we made it back. No, you didn't, because during that period, inflation was well over 50%. So the 1,000 in 1982 was only worth about 500 in 1969 dollars, if you want to think of it that way. So 13 years to get back to your nominal high, and you're only halfway back to a real high. So that's the kind of thing to bear in mind. But that's true today. In fact, I just saw a study, I believe it was done by an economist or researcher at Deutsche Bank, but I saw it was in Bloomberg, so you can find it online pretty easily. And it said the same thing. Today, U.S. stocks, every day, Dow an all-time high, S&P 500 an all-time high, et cetera, et cetera. Happy days are here again, buy stocks. And it said, actually, no. If you adjust for inflation, because we have had the highest inflation in 40 years, in June 2022, inflation was 9.1%, and that, year over year. Okay, it's come down a little bit, but it's still relatively high. If you adjust for inflation, gold has outperformed stocks. This particular study was 25 years. Okay, a quarter century from 2000 to 2024. That's not a small sample. That's the other thing that drives me crazy when people do comparisons. I'm like, well, you have a 2-year time series. Can we do 10 years at least? This was 25 years, which I thought was interesting. And it said gold and other commodities have outperformed stocks in the last quarter century when adjusted for inflation. So first of all, your point is well taken. Gold is robust to that. But I'm calling gold the everything hedge. People, I think when you say it's an inflation hedge, which it is, you're not giving gold enough credit because gold has done well in the past year. Inflation is higher than it has been for a while, but it's not. It was screaming in 2022. But this is U.S. data. I know it varies by country, but pardon me. It was. It's been higher than it should be, but moderate for the past year. But gold is surging anyway, so it tells you there are other factors in the gold rally other than just inflation. So is it an inflation hedge? Yes, but to say, well, gee, I'm going to buy gold when inflation comes along. Okay, but you might be missing out. In fact, you are. The data says you are missing out. It's a hedge against geopolitical uncertainty. It's a hedge against sovereign risk. I happened to have shared an office with Myron Scholes for 6 years. He was very generous with his time. He used to come into my office on slow days and give me, the way I would ask a dumb question, and he'd give me like a private tutorial. So I see options in my sleep. But part of the Black-Scholes, he won the Nobel Prize for the Black-Scholes formula, options pricing formula. But part of it says the U.S. Treasury bill is the risk-free rate. You need the risk-free rate, past performance. There's a little bit of Ito's calculus thrown in for good measure, but the risk-free rate is a key element of that. My question for Myron or anyone, I haven't seen Myron recently, but would be, ask the Russians if they think U.S. Treasury securities are risk-free. The U.S. not just in 2022, at the beginning of the special military operation in Ukraine, we froze $300 billion worth of Russian-owned, lawfully purchased U.S. Treasury securities. Now we're in the process. Freezing is one thing. The U.S. is very good at that. Ask Iran and a bunch of other places. But now we're in the process of stealing them, working with most of those securities, by the way, $200 billion of the $300 billion of Russian-owned U.S. Treasury securities are on the ledger at Euroclear, which is the largest clearing firm in Europe, which has $40 trillion of assets on its ledgers. But we're in the process of converting 50 billion of that into as collateral for a loan to Ukraine to perpetuate the Ukrainian war. So here, Russia earns the reserves lawfully by selling energy and other exports. They lawfully buy U.S. Treasury securities. They're in a war in Ukraine for a lot of other reasons, and the U.S. is stealing the assets to finance the war against Russia. So again, don't talk to me about risk-free rates. There's risk everywhere. Why has Russia not collapsed? I mean, actually, the Russian economy is outperforming the U.S. economy, has since the beginning of the special military operation. Russia's biggest economic problem right now is they can't find people to fill all the factories. I mean, their economy is booming, so they have an employment issue, but it's not unemployment. It's they can't find enough workers. They're doing extremely well. Why has the economy not collapsed? Well, there are a lot of reasons, but one of them is Vera Nabiullina, who's the head of the Central Bank of Russia. I always describe her as the only central bank in the world who knows what she's doing. Put 25% of their reserves in gold, physical bullion in Russia. So at the going back to 2022, round numbers, Russian reserve position was $600 billion, but $150 billion of that was in gold bullion. And then, of course, much of the rest was in Treasury securities. But the reserve position was never wiped out because they weren't completely, fortunately for them, not relying on the U.S. Just an ironic footnote to that, because of the impact of U.S. sanctions and because of the rally in gold, while the U.S. is busy, stealing the Russian Treasury securities, Russian Federation has booked a $50 billion mark-to-market profit on the gold, because with a given quantity of gold, when gold went from about 1,800 or so, now close to 2,800, take that increase in dollar value, and the gold reserves have gone up $50 billion. So, so much for depriving Russia of its reserve positions, actually making profits on the gold. So, but the point being, there's a case where it had nothing to do or little to do with inflation, everything to do with geopolitics. And that's why I call gold the everything hedge. It hedges a lot more than just inflation.